And before we start, guys, I just want to start by saying I am not a financial advisor. This is just food for thought. Thanks for your time today. Enjoy the video. What's going on, guys? It's Anbu here, signing on for another video. Today I wanted to bring you something a little bit more exciting, something a little different. So today we're going to be discussing the Ultimate 10 stock portfolio. This portfolio is designed to be diversified as much as possible within 10 stocks, designed to capture high growth potential, designed to limit the downside, companies that have strong moats around their business, companies that have durable businesses, and companies that, in my perspective, have a very bright future. And if you were to go with this portfolio, likely your pockets would have a very bright future. Let me know what you guys think. There will be some honorable mentions at the end. There's so many great companies that could be part of this list, especially if we took it up to 15 count. And that would actually be easier to create than the 10 stock portfolio. So stick around for those and let me know what you guys think. If there's stocks that you think should replace some of these, drop those down in the comments below. Thanks so much for your time, guys. Let's jump into it. These stocks today will not be in any particular order, but we just so happen to be starting off with my favorite stock, which is going to be Microsoft. And the reason I say that is because Microsoft has such a broad product range. Overall performance, we see that they really jumped up around that .com era, and then really started peaking again around 2016, and have had tremendous growth since then. Their PE is showing as right around 32, earnings per share at 12.43, and a market cap near 3 trillion. Analysts are targeting that their share price will reach $500 within 1 year. Their forward dividend is 332. Off the bat, we see that Microsoft is a company that, one, pays dividends. Two, Microsoft is a company that reinvests and repurchases shares. Three, Microsoft is a fast-growing company. Four, Microsoft itself is a well-diversified company, even growing into the future with AI now. Let's go ahead and look at their products. Alright guys, so I went ahead and pulled up this chart that I found online. This is showing Microsoft's revenue by product, which I thought would be an interesting view. So we have 80 billion coming from Microsoft Azure, which is cloud computing services. Office Microsoft 365, so cloud Office suite software. Windows 11, so they're making 22 billion from the operating system. Very impressive. Xbox, obviously this is a stream that they've been growing and have been continuing on for many, many years. Same like Windows. LinkedIn, huge platform. Wow, LinkedIn's already rivaling Xbox revenue. That's incredible. Copilot, so their new AI search engine, already bringing in 12 billion. Other total revenue, 211 billion. So the bulk of their revenue at the moment is coming from cloud. Pretty impressive. Cloud is a fast-growing offering. Alright guys, next up is Apple, AAPL. So this is another extremely popular stock. One of the best performing stocks over the past 2 decades. Apple, they've been on a tear. They've been on a run since, obviously, the launch of the iPhone. At the moment, their earnings per share are 631, PE at 38, forward dividend and yield at 0.41. So low dividend, lots of room for growth, similar to Microsoft. They're doing share buybacks, which is awesome. They're paying dividends. They're quickly growing those dividends. And their 1-year target is at 252. For the year, Apple's up 33%. Apple's a company that, I've kind of called out in the past for being a little less innovative recent years. Although that's the case, they're one of the most well-managed companies in the world. They still have very high demand products. I buy Apple products. I buy MacBooks. They're very expensive. Buy the iPhone. It's very expensive. So whenever you do end up making that Apple purchase, it's going to be a big purchase, and you usually are a customer locked in for a good track record. I don't foresee myself switching back to PC anytime soon, although my Mac was significantly more expensive than most PCs, as other Apple customers can attest to. So with that, I believe Apple has significant pricing power. Another reason I really like Apple is because Apple's sitting on a lot of cash that gives Apple the potential to do a lot of things whenever they decide to pull the trigger on something new and highly innovative. They're making huge investments. They still have super high in-demand products, and their brand power is just so powerful. So for these reasons, Apple definitely deserves to be on this list. We see in 5 years they're up 253%. Like we mentioned, they're up 33% for the year. Very impressive. All right, guys, so I did some research to look deeper into Apple's revenue for you guys. We see for 2024, the iPhone brought in more than 50% of revenue. So incredible. iPhone's still an amazing product. The Mac is pulling in about 8%. We have services at 24.59%. Wearables coming in close to 10%. And iPad coming at near 7%. So this is interesting to see. I see services here. I think that one thing with Apple is they're going to continue really growing their cloud storage. I think they have a lot of pricing power on that. With that, we're going to see great growth on that business. I believe that they do have great accessories. There could be, in my opinion, some overlap in their product range. Like they have the AirPods, and then they have the Beats, and then they have other headphones that they also make. So that's just one example coming to mind, but there is some overlap in their product range. And with the tougher economic times, like for myself, I have the AirPod Pros, for example. I have a lot of Apple products. I had a couple Apple Watches, but should anything happen to my AirPods, just me personally, even though I'm an Apple investor, I'll just say that I probably will just buy a cheap off-brand product from Amazon. Just whatever works, just quickly connect. Now, I know that Apple has patents in place and that they don't make it easy to quickly connect to the Apple products like the AirPods, but I'm willing to, jump down a little bit in performance. I wear other Bluetooth headphones. I have Samsungs, I have Sony's, I have Bose headphones. So I'm open to switching around, and but I'm just highlighting that a lot of people I see, even they switch from the Apple Watch, they get a cheaper alternative. They have the iPad, people get a cheaper alternative. And there has been a lot of cheapening of the brand, I would say. So that is some kind of risks. That is a risk. Like, phone companies like Verizon, AT&T, they'll give out free iPhones. They'll give out free iPads. They may give out free Apple Watches. I got a free Apple Watch from Verizon, for example. So I would like to see Apple actually increase their Mac revenue, personally, because the Macs I know are very expensive products, even compared to the iPhones. So that would be good if they're able to ship out more Macs. But anyways, hope this chart was helpful. It is great to see that the iPhone is still bringing in so much revenue. As you guys know, if you know people with iPhones, there's a high chance they'll stick with iPhones for the foreseeable future. So Apple is going to stick around for a long time. And with so much money on hand, I really think Apple's going to come out with something strikingly incredible in the very near future. Next up on the list is going to be Amazon, AMZN. So Amazon is an incredibly well-diversified company. It's a company that has, as we all know, they're the largest online retailer. They sell everything under the sun. They're pretty much been putting everybody out of business for the past 2 decades. They're on a tear, absolute tear. Let's see how their stock's been. Last 5 years, you're up 125%. Last year, you're up 22%. A lot of growth has been priced into Amazon. They don't pay dividends. Their PE, however, is still similar to the other companies that we previously viewed. 38.26, earnings per share at 5.54. And their target estimate for the year is 266. So it looks like they have a lot of growth potential expected within this year. I really like Amazon because as I look to the future, as I look to the tides of how their business is growing, I just see so much future opportunity for them, so many ways that they can drive more margin in their business, easily bring in more revenue. They have so much market share over their competitors. pretty much are competing in a monopolistic space. In a sense, we're still in the early days of the internet, and Amazon is really still capitalizing on that like crazy. All right, guys, I was able to pull up a chart of Amazon's revenue breakdown. So they're bringing up 8% from advertising. I really think that this can grow significantly. Amazon Web Services is at 16%. This is one of their faster growing. This is one of their faster growing areas. Subscription services, third-party seller services, more service. Amazon's a huge platform. If others can take advantage of their platform to make profit and Amazon can share the profit, that's great. They do that in many different ways. Physical stores coming in at 3.48. Really, we see the majority here in their online stores. No surprise, but actually more diversified than I think many would expect on first glance. And they have a lot more coming, Amazon. I mean, really incredible, all the product offerings that. All right, guys, next on the list is Chevron. So as you can see, Chevron has had a very impressive performance over its lifetime. Last 5 years, it's up 70%. Last year, very modest 4%. They're trading at a PE of 16.32. Earnings per share at 9.72. 1 year estimate at 176. And a forward dividend yield at 4.31%. I'm under the impression that oil has a long future ahead. I think we've seen a big turnaround in the EV markets and the EV demand. I think that in general we're a lot more dependent on natural gas, fossil fuels, traditional energy than many want to accept. And it is a finite resource as far as we've been told. So I think with that, as supply decreases, we should see increase in pricing. That's going to give those major factors give me confidence in just a general market that Chevron operates within. And Chevron happens to be, in my opinion, a strong, well-run company. It's a company with a long history, obviously staying power. It's a very traditional stock that offsets and gives great diversification in such a portfolio. Next up is the Coca-Cola Company, a consumer discretionary stock. Next up is the Coca-Cola Company. This is definitely a staple company. They're currently trading at a PE of 28.95, which is quite impressive for such a long-standing company that's not in the tech space. Their earnings per share is at 2.46 with the 1 year target at $74. And they have a forward dividend yield at 2.86. We see the performance, 5 years it's up 33%, 1 year it's up 18%. So 18% is very impressive. There was a lot of noise lately, especially with a lot of recent political events. But we see that Coca-Cola has rebounded from those periods, which is great. I was actually purchasing in these periods, taking advantage of this dip here, because Coca-Cola is a company that rarely goes on discount. Guys, Coca-Cola is a company, it's a brand where their products have been consumed more and more every year, every day, for decades and decades. It's been continuous growth in demand, consistent customer base. Some might say they sell an addictive product. Arguably, they do, like many other companies. But it's something that the consumer really loves. People really enjoy their Coke. If you're around people that like their Coca-Cola or their Sprite, and they always drink Sprite, they want Sprite with every meal when they want to feel good. Guys, they're probably not going to change that anytime soon. So for these reasons, I believe Coca-Cola is a company that has been not only has been around for a very long time, which I don't just need to believe that, we all know that, but it's a company that I believe will be around for many years to come and will continue to see strong growth. Next up, paired with Coca-Cola, I'm also including PepsiCo in here. PepsiCo, similar great story as Coca-Cola, amazing company, great growth, potentially room for more growth. The performance hasn't been as great as Coca-Cola. As we see, looking at the 1 year and the 5 year trend. Looking at the PE, it's a little bit lower PE. That's favorable. It's at 22. PE, EPS at 6.95, not bad, and a forward dividend yield at 3.53. So that is an impressive starting. That's an impressive forward yield for Pepsi. They are down quite a bit recently. Let's see where they're at the moment. So at the moment, they are near lows within the last 6 months, having a slight rebound similar to what we saw in Coca-Cola. This is a company that I was loading up on in all these periods, as you can see in my other video. And Coca-Cola, I think, would be a great addition to the portfolio because it covers the pretty much the other market share of soft drinks of people that maybe don't like Coke products or they happen to fancy a particular Pepsi product, such as the main Pepsi drink. Another thing about Pepsi is that they have a lot of other brands that they own. I think a lot of people maybe don't know that, so I'll go ahead and quickly bring up Pepsi's revenue. This is a breakdown of Pepsi's revenue. So we see a large bulk coming from Frito-Lay, another large bulk coming from North America Beverages, another, and then other large areas of the revenue coming from Latin America, Europe, APAC, and others. And we see that they've been growing in Frito-Lay, North American Beverages, Latin American market, the Europe market, and APAC. Next up is Lockheed Martin. This is a stock that I've been loading up on throughout the year. As you guys know, it's been one of my favorite buys at the moment because it was on a dip, because it has been on a recent dip from this peak that we saw here late last year. So because it's been on a big dip recently, it's only up for the year 4.14%. 5 years up 21%. They have a PE of 20 and earning per share at 22.29 with a forward dividend yield at 2.93. I like Lockheed Martin for lots of reasons. They're a company that produces something very important for our country. They're a company that produces defense items, defense materials. They're a defense contractor. And that is, as we all know, that is and has proven to be a durable and profitable business. It's a company that I think has strong staying power. It's a company that has long contracts into the future, and it's a company that pays strong dividends. And I just think that with the state of the world and the state of the current times that we're in, I just think Lockheed Martin is a company that will be profitable for years and years into the future. Even if there is an administration, perhaps let's say that there's an administration that comes in that wants to reduce war. There's always changes in administration every couple of years, and this is something that just looking back at history, there's been wars since the beginning of time, and I think that it's something that unfortunately may continue. And on the other side of that, on the flip side of that, many say that the best defense is a strong offense. So if companies like Lockheed continue to produce superior military equipment, that can keep things rolling along, keep the country in prosperity through strength. Anyways. Alright guys, next up is Altria Group, one of my favorite stocks. Altria Group in the last 5 years are up 38%. Last year they're up 36%. So quite impressive performance over the past year. When I look at the alt chart, I see that they had a sharp drop off in 2008 and still haven't quite fully recovered from those previous highs. We see that they have a PE trading at only 8.54 with earnings per share at 6.54 and forward dividend yield at 7.31. Why do I like Altria Group? Altria Group pays tremendous dividends, which is one thing that I absolutely love about Altria Group. Altria Group also has had great performance over the years. It's a company that I think would have even more impressive performance if not for strong regulation and opposition. It's a company that naturally has strong demand and they have great product offerings. When I say they have great product offerings, of course there's other tobacco companies, but I happen to think Altria Group has the most impressive portfolio. The reason I believe Altria Group belongs in this portfolio is because it provides strong diversification against the other companies I've been mentioned. Additionally, Tobacco is an industry that has been around since pretty much the beginning of the United States. So I think it's a industry that will have a future for years to come, despite the continuous regulations and increase in taxes that have been placed on the industry. Next up on the list is Visa. So obviously Visa is a well-known, very impressive stock, like all the other stocks on this list. The last 5 years, it's up 100%. In the last year, it's up 27%. They have a forward dividend yield at 0.65%, quite low. They grow their dividends quite quickly. Their PE is at 36.64, so a little bit on the higher end, but not as high as some of the other companies that we've seen. And their earnings per share at 9.9. 1 year target estimate 373, so not too far off where we are at the moment. Why do I like Visa? They have such a monopoly type position in the market. Although it's not a monopoly, I would definitely consider the industry an oligopoly. There's only a few big players, of which Visa is definitely the dominant player. Most transactions involve Visa going on within the United States. Most people use Visa. Most cards are Visa. They're most accepted widely. Cash is quickly going down in use. MasterCard, Discover, they have their place. Amex, they have their place. And there's definitely a lot of growth potential for those companies. But Visa continues to be the dominant player, and I think they have a lot of pricing dominant player. And I know that these companies have a lot of pricing power over their customer base. They can rapidly raise their margins. They can quickly raise their margins on the merchants that use their products, drive up more use, and they continue to grow their footprint and dominance. So overall, I think Visa is a company that will be here for years and years to come. Next on the list is American Express. They have great returns, been around for quite some time. Last 5 years, they're up 174%. Last year, they're up 38%. Why do I like this company? It's similar to Visa in some ways. Their forward dividend yield is 0.93, earnings per share at 14, and price to earnings at 21.47 with a 1 year target 316. So why do I think that Amex is a great company? One, it is a smaller company, so it has more room for growth. It's a company that is a little bit more diverse than Visa in that not only do they do the payment networks, so Amex does have that benefit and has a lot more growth potential with that. Not as many businesses offer Amex, so they can quickly continue to grow that revenue growth. They can keep growing based on their pricing power. They can grow their margins. But additionally, they also act as a card issuer. You might have an Amex card, others will have Amex cards, and that just acts as a whole nother really profitable revenue stream that brings it into the realm of other major card issuers, such as the banks, eating into the banks' territory, such as Bank of America, Chase. Maybe you have a Chase Freedom card, blah, blah, blah. So I really like that. Diversity in Amex's business model. There's a lot of exclusivity and brand recognition with Amex. You definitely get some cool points. Amex has really positioned themselves as the cool guy card. Having an Amex card can sometimes be a flex, such as having the black card. So I really think that Amex is a company that's been around for a long time, and it's a company that I continue to foresee being around for a long time. And I think it deserves its place in this portfolio and pairs quite nicely with Visa and doesn't fully overlap and offers more diversification from Visa. So there we go, guys. That is a 10 stock portfolio that I brought forward to you today. Let me know what you think about these 10 amazing companies. Let me know if you think that this portfolio is well diversified, does make a great portfolio, is simple enough, and would likely deliver good performance for the shareholders. I do want to mention that creating this list was difficult because there are so many amazing companies. It would be easier to do this list if I could bring it up to 15. Honorable mentions will be banking and railroad stocks, as well as Realty Income and Google. When I say banking companies, I probably would go with the big guy like Chase. I think Chase is a wonderful bank. It's the bank that I bank with personally. And then two more, I would pick one railroad stock and maybe one other railroad stock or one other oil company. That is my diversified portfolio. If I could cheat a little bit beyond 10, but overall, guys, with those 10 I gave you, that's an already incredible amount of diversification. And if I did want to make the portfolio a little bit more risky, I probably would swap out two of those companies that are slower growing and higher yielding for something like ASML and Taiwan Semiconductor Manufacturing, a little bit more risk, but potentially a lot of more upside. So there are things we could do to tweak it a little bit more. Also, let me know your thoughts on that down below. Thank you guys so much. If you do like this kind of content, please let me know. I did try to switch it up today. Please like, comment, and subscribe. Thank you so much for the support. Love you guys. Take care. Anbu out.